Now, let's dive into group audits, specifically focusing on how an auditor ensures that the list of components to be consolidated is actually complete. Think of this as a checklist phase. You don't want to miss any subsidiary, associate, or joint venture, because that would lead to a material misstatement in the consolidated financial statements.
Make sure nothing is missing. The auditor should start by looking backward and outward. First, review your own working papers from previous years to identify known components. Then, look at how the parent company itself identifies its components. What is their internal process? Next, get proactive. Talk to management. Ask them directly if any new components were added or if any were removed during the year.
But don't just rely on what management says. Verify it. Review the investment registers of the parent and its components to see who they actually own shares in. Check for joint ventures and any other special arrangements that might not have made it into the consolidated statements yet. For a more formal verification, go to the statutory records. In the Indian context, this means reviewing registers under Sections 186 and 190 of the Companies Act, 2013. You also need to track any changes in shareholding that happen during the reporting period.
Now, how do we actually prove control, joint control, or significant influence? It's not always just about owning more than 50% of the shares. You should examine the board minutes, read through shareholder agreements, and look at technology or know-how agreements. Sometimes, control is established through a contract rather than just equity.
A pro tip here, always review the board minutes after the year end. Why? Because if the parent company liquidated an investment right after the balance sheet date, it might reveal that the control was only temporary, which changes how you view the consolidation. Finally, let's talk about exclusions. If a component is left out of the consolidated statements, you must ask why. And is this allowed under the reporting framework? For example, under the accounting standards rules, a subsidiary might be excluded if the relationship is intended to be temporary, or if the subsidiary is under severe long-term restrictions that stop it from sending funds back to the parent. Also, keep in mind a specific exemption under the Companies Act, 2013. An intermediate subsidiary in India may not be required to present consolidated financial statements if it meets certain specific conditions.
Remember, every single one of these steps must be documented. If you didn't write it down, in the eyes of the audit standards, it didn't happen. Keep this systematic approach in mind, and you'll master the complexity of group audits.
Now let's dive into a very critical area of auditing, the exemptions from preparing consolidated financial statements under IND AS 110. As an auditor, you must remember that while consolidation is the general rule, there are specific criteria where a company is not required to consolidate. Your job here isn't just to take management's word for it, but to rigorously verify that these exclusions are valid.
For instance, imagine a scenario where management claims they aren't consolidating a subsidiary because the relationship is only temporary. You cannot simply accept this. You need to dig deeper and verify that the intention to dispose of that subsidiary, associate, or joint venture existed right at the time of acquisition. It's all about the timing and the intent. Furthermore, ensure that the reasons for this exclusion are clearly disclosed in the financial statements.
Now, what happens if a company excludes an entity for reasons that aren't permitted by the financial reporting framework? This is a red flag. In such a case, you must carefully evaluate how this misstatement or omission affects your audit report. You might be looking at a qualified or adverse opinion depending on the materiality.
Another key area for you to monitor is the change in status of a component. For example, if a subsidiary becomes an associate or a joint venture shifts to an associate, this change must be accounted for correctly according to the relevant IND AS. You need to ensure the accounting transition is seamless and accurate.
Finally, let's look at the specific exemptions under the Company's Accounting Standards Rules, 2006. A company may be exempt from presenting consolidated financial statements if it meets certain conditions. First, it could be a wholly owned or partially owned subsidiary where all other members have been notified in writing and have not objected. Second, the company's securities must not be listed or in the process of being listed on any stock exchange. And third, its ultimate or intermediate holding company must already be filing consolidated financial statements with a registrar that comply with the applicable accounting standards.
Now, let's dive into the complexities of group audits, specifically focusing on how we handle the consolidation of financial statements. This is a critical area for any CA final student, so let's break it down into two frameworks, the traditional accounting standards and the modern IND AS. First, if the entity is following the traditional accounting standards, we look at as 21 for consolidated financial statements. The core objective here is to ensure that the group is presented as a single economic entity. This means we must eliminate all intra-group transactions, balances, and any unrealized profits. Think of it this way: a company cannot make a profit by selling something to itself.
When it comes to other types of interests, we use the equity method for associates as per as 23, and for jointly controlled entities, we use the proportionate consolidation method under as 27. You'll find that the procedures for these are quite similar to the general consolidation process in as 21.
Now, let's shift our focus to the company's Indian Accounting Standards Rules 2015. This is where IND AS comes into play, and the approach is very precise. Under IND AS 110, the parent and subsidiaries are combined on a line-by-line basis. This means you add together like items assets with assets, liabilities with liabilities, and income with income. For the technical calculations, IND AS 103 guides us in determining goodwill, capital reserves, or gains from bargain purchases, as well as calculating the non-controlling interests. If we are dealing with business combinations under common control, we use the pooling of interest method. Just like before, all intragroup transactions and deferred taxes must be eliminated according to IND as 110.
For associates and joint ventures, IND as 28 mandates the equity method. However, if it's a joint operation, IND as 111 requires the entity to account for its specific share of assets, liabilities, and revenues in its separate financial statements. One very important point to remember for your exams is the concept of a business combination achieved in stages. In this case, the acquirer must remeasure their previously held equity interest at its fair value on the acquisition date, and any resulting gain or loss is recognized in the profit and loss account or other comprehensive income.
As an auditor, your primary responsibility here is verification. You must ensure that all these adjustments required by the applicable framework have been correctly made and, crucially, that they have been formally approved by the parent company's management. Keep in mind that consolidation leads to two types of adjustments, permanent ones and those specific to the current period. Master these distinctions, and you'll have a strong grip on group audit requirements.
Now let's dive into a critical area of group audits, ensuring that the consolidated financial statements are truly complete and accurate. First, as an auditor, you need to look beyond the obvious. While subsidiaries are easy to spot, you must pay close attention to off-balance sheet entities. These are entities that might not technically meet the legal definition of a subsidiary, but the parent company may have transferred significant business risks to them. If you miss these, you miss a huge part of the risk profile. Along with this, keep an eye out for de facto control. This is a vital concept. De facto control happens when an investor doesn't hold a majority of the voting rights. Perhaps they have less than 50%, but they still have the practical ability to direct the company's activities unilaterally. If they call the shots, they control the entity, and it must be accounted for.
Now, let's talk about permanent consolidation adjustments. These are not your typical year-end entries. These adjustments are made only once at the time of the initial acquisition or whenever there is a change in the shareholding of a consolidated entity. There are two primary areas you need to verify here. First is the determination of goodwill or a capital reserve, based on the applicable accounting standards. Second is calculating the exact amount of equity that belongs to the minority interests, also known as non-controlling interests.
To get this right, your focus must be on the pre-acquisition reserves. The date of investment is everything here. It determines what belongs to the parent and what belongs to the minority interest. You must verify that these calculations are accurate and that the allocation between the parent and the non-controlling interests is handled correctly. If the pre-acquisition reserves are wrong, your goodwill and minority interest figures will be wrong, which ripples through the entire balance sheet.
Now, let's dive into the critical area of group audits, specifically focusing on consolidation adjustments. When you're auditing a group, you'll encounter two main types of adjustments: permanent and current period adjustments.
First, let's talk about permanent consolidation adjustments. These are adjustments that stem from the initial acquisition of a subsidiary and typically carry forward. However, as an auditor, you must be vigilant. You need to verify if any changes have occurred in these adjustments due to subsequent events, such as the parent company acquiring more shares or disposing of a component. For example, imagine a scenario where the parent company, XYZ Limited, originally held 70% of a subsidiary, ABC Limited, but later reduced that control to 55%. This change in the share of equity triggers a permanent consolidation adjustment.
A key point for your exams and practice is the treatment of goodwill and capital reserves. In some cases, one subsidiary might result in goodwill, while another results in a capital reserve. If the financial reporting framework allows it, the parent company might net these two amounts off to show a single figure in the consolidated balance sheet. If they do this, your job as the auditor is to ensure that the gross amounts of both goodwill and capital reserves are clearly disclosed in the notes to the financial statements. This ensures that the excess or shortage over the parent's portion of the subsidiary's equity is transparently reflected.
Moving on, we have current period consolidation adjustments. Unlike permanent ones, these are specific to the accounting period currently being consolidated. The most common example here is the elimination of intercompany transactions. Think about it this way. If a parent company sells goods to its own subsidiary, that sale isn't a real sale from the perspective of the group as a whole. The goods are still within the family. Therefore, to avoid inflating the group's revenue and profits, the auditor must ensure that intercompany purchases and sales are eliminated. This ensures the consolidated financial statements only reflect transactions with third parties, giving a true and fair view of the group's performance.
Now, let's dive into current period consolidation adjustments. When we are consolidating financial statements, the primary goal is to present the group as a single economic entity. This means we have to strip away any transactions that happen internally within the group.
First, we look at intergroup transactions and balances. Think of this as cleaning up the books. We must eliminate interest paid and received between the parent and its subsidiaries, as well as any management fees. We also clear out any intergroup indebtedness, as the group cannot owe money to itself.
We also need to remove unrealized intragroup profits. For example, if one subsidiary sells an asset to another at a profit, and that asset is still within the group, that profit isn't really up from a group perspective and must be eliminated. Along with this, remember to record deferred taxes on these eliminations, following Ind AS 12.
Next, we have to ensure consistency. If the parent and its subsidiaries are using different accounting policies, we must make adjustments to harmonize them so that the consolidated statements are comparable and consistent.
Now, let's talk about a critical area: subsequent events. These are transactions or events that happen between the balance sheet date and the date of the auditor's report. There are two types you need to distinguish. The first type are adjusting events. These provide additional evidence about conditions that already existed at the balance sheet date. These must be adjusted in the financial statements. The second type are non-adjusting events. These relate to conditions that arose after the balance sheet date.
While these don't require a numerical adjustment, if they are significant, they must be disclosed. In those cases, you need to disclose the nature of the event and an estimate of its financial effect, or state if such an estimate cannot be made. Finally, we must account for any significant transactions that occurred between the date of a component's individual balance sheet and the date of the group's auditor's report, assuring these are properly recognized in the consolidated totals.
Now, let's dive into the complexities of group audits, specifically focusing on the critical adjustments required when preparing consolidated financial statements. As a CA final student, you need to realize that consolidation isn't just about adding numbers together. It's about ensuring a uniform and accurate picture of the entire group.
First, let's look at the common challenges an auditor faces. One major issue is timing. Sometimes, a component's financial statements are drawn up on the same balance sheet date as the parent's. You'll need to be mindful of this gap. Similarly, if you're dealing with a foreign component, you must ensure that the local GAAP of that component is correctly converted to the GAAP used by the parent for consolidation.
Now, pay close attention to the non-controlling interest, or NCI. You need to determine the movements in equity attributable to these minority interests since the date of acquisition. Here is a crucial technical point for your exams. Under IND as specifically paragraph 28 of IND as 27, the NCI can actually have a negative or deficit balance if the subsidiary's net worth is negative. This is a key departure from the older accounting standards.
Next, don't forget the tax implications. You must account for deferred tax adjustments arising from temporary differences. These usually stem from the elimination of intergroup profits and losses or undistributed profits of the component.
Now, how does the auditor actually verify this? Typically, the parent company maintains memorandum records for these consolidation adjustments. Your job as the auditor is to review these records thoroughly. But you can't stop there. You must specifically verify three things. First, that all intragroup transactions and balances have been completely eliminated. Second, that uniform accounting policies have been used for similar transactions across the group. And third, that any deviations from these policies are adequately disclosed.
On the topic of accounting policies, remember that impracticable has a specific meaning. It means the entity cannot apply the policy even after making every reasonable effort. Under IND as 110, you must ensure that adjustments are made to a group member's statements to bring them in line with the group's policies. While older standards like as 21 might allow different policies, if harmonization is impracticable, IND as is more stringent. Even with associates under IND as 28, if different policies are used, adjustments must be made so the financial statements conform to the parent's policies when applying the equity method.
Now, let's dive into the critical audit procedures required when dealing with consolidated financial statements. This is a high-stakes area, so pay close attention to these specific verification steps.
First, we need to look at accounting policy alignment. When a parent company consolidates a subsidiary, that subsidiary might have used a different GAAP or set of accounting policies. As an auditor, you must verify the adjustments management has made to harmonize these policies. Essentially, you are ensuring that the components' financial statements have been correctly converted to the GAAP used for the consolidated reports. Next, move on to the calculations. You need to verify the calculation of the non-controlling interest, also known as minority interest. If the parent company maintains its accounts under IND as, you must specifically verify the deferred tax adjustments. These arise from temporary differences when you eliminate profits or losses from intergroup transactions.
Timing is also crucial here. You must verify that the income and expenses of the subsidiary are included in the consolidated statements starting exactly from the date the parent gained control, right up until the date control ceased. Furthermore, ensure these figures are based on the assets and liabilities recognized at the acquisition date. To manage your audit risk, always start by gaining a deep understanding of the procedures management used to make these adjustments. This is your foundation for a low-risk audit.
Now, let's talk about one of the most critical adjustments, goodwill impairment. Remember, goodwill is carried at its acquisition value and must be tested for impairment at every single balance sheet date. Your job is to check if the parent company has determined an impairment loss. If they have, you must examine their procedure and satisfy yourself that the amount is fair.
There is a special twist if the goodwill is in a foreign currency. In that case, you need to check if any loss in the local currency needs to be adjusted from the currency translation reserve. This accounts for exchange rate movements from the date the goodwill was first recorded to the date the impairment was determined. Additionally, keep an eye on intergroup losses, as these can be a red flag indicating that an impairment loss needs to be recognized.
Finally, regarding non-controlling interests, go beyond just the basic calculations. You need to check the specific scenario where the minority interest's share of losses exceeds their share of equity. In such cases, you must ensure that the excess and any further losses are accounted for strictly in accordance with the relevant accounting standards.